In today's episode, I'm going to be covering a technique that I call intraday equity flow analysis, and if undertaken correctly, this can be used to help improve the results of any intraday trading strategy. Hang tight, I'll be right back after this brief message. Darwinex is a UK FCA regulated broker and asset manager on a mission to disrupt the financial trading, investing and asset management industries. If you're a talented trader looking to attract investor capital to your strategies, Darwinex is the fastest way for you to do this. We enable traders to raise third-party investor capital and then charge success fees on high watermark profits. Additionally, Darwinex itself invests in its traders with our seed capital allocation program that allocates up to 90 million euros per year in successful trading strategies. So, if all of that sounds interesting, learn more by clicking on the link here, or you can find further links in the description right below. Now back to today's tutorial. So let me first put a little context around today's discussion. I've been looking in quite some detail at several indicators and specifically comparing the effectiveness of RSI with the newer stochastic RSI indicator for a typical overbought oversold trading strategy. So if you're just coming into this for the first time, then I'll try to make this episode as self-contained as possible, but if you find you get value, then do consider subscribing to the Darwinex channel, and also please take a look at some of those previous episodes in our channel playlists, and I'm sure you'll find many that will be useful to your own trading. Now, back to today's topic. Alongside this comparison of indicators, I've also been using this as an opportunity to share some other techniques that I utilize personally around time of day analysis. And within this, there are two types of analysis that I'll be covering. The first of these is what's called time of day filtering, and I've spent the previous 3 episodes looking at this in quite a lot of detail. And this, of course, is concerned with the filtering of open signals. And so specifically, this answers the question of is a trade allowed to open or not? And so this allows us to target the various times of day that are most suitable for a particular trading strategy. And I went through the analysis of data that was required to inform this and then implemented it for our overbought, oversold strategy to see the improvement in the results that produced. But now I move on to the second category of analysis, which is intraday equity flow. So I'll start to explain the theory of this in today's episode, and then in the next 2, I'll actually take you through the implementation for the stochastic RSI and the RSI strategies that we've been looking at, and we'll see if we can get an improvement in each of those strategies. So, if the first category, time of day filtering, is concerned with filtering open signals, how is this second analysis different? Well, this is concerned with trades once they are already opened. So those that passed the test and were allowed to open using the first filtering technique are now analysed to see how those trades behave throughout the different times of the trading day. And of course, what we're interested in, once a trade is open, is how long do we retain that trade for before closing it. And intraday equity flow analysis helps to inform that decision. So to summarise, it answers the question, should a trade be exited before its organic exit signal? And by organic exit signal, I'm talking about the signal to close the trade based on the indicators that we've been using. But what intraday equity flow analysis does is provide an alternative exit for your trade that might happen before we get that organic exit signal, when it's more preferential to do so. So let's take a quick look at the difference in the analysis of data for each of these two. This is the data we used in the past 3 episodes, and it shows the profitability of trades based on when they were opened. And the conclusion that I came to for the stochastic RSI and the standard RSI was that trades that were opened in the Asian session tended to do best. And I also looked at reasons why that might be the case. And because the overbought, oversold strategy is effectively based on a mean reversion premise, trades that were opened initially in the Asian session could then take advantage of a change in direction of price that we very often see when the European markets open. So let's now move on to the data for the equity flow analysis. And this is different. In this analysis, it shows on average how well open positions perform hour by hour throughout the day. So as an example, we can clearly see here between the hours of 7 a.m. and midday, any open positions have a positive impact on the equity on the account. After this time, we can see there's then a degradation where the equity on average goes down. Now, I think it will help to look at both of these side by side. Here at the top, we made the decision that we would have a time of day filter that only allowed trades to open in that Asian session. And then the chart that you see at the bottom here shows the equity flow hour by hour for those trades that opened in the Asian session. So no trades were opened after 9 a.m. in the morning. But of course, those trades that were opened remain open until we get a close signal, which is why in the bottom chart we have values all the way through the trading day. Now, don't worry about how I'm calculating this data at the bottom. I'll be covering this in detail in the implementation episode, which will come next. So I will share the technique with you, but for now, we're just looking at the theory and how this can be used. So, take a look at what happens. We opened trades during the Asian session, and just like the hypothesis that I put forward in previous episodes, we then see a very positive impact on the equity in the first half of the European session. And so this is backing up the argument that on average, the markets tend to mean revert between what happened in the Asian session and what then happens in the European session. And so we looked at many examples of price charts and anecdotally saw that this was the case, but this is the proof. What we also saw is that when the US markets opened, often prices mean reverted again. And look here, we can see that when the US markets open right here, suddenly the trades that we'd opened in the Asian session now start to lose the profit that they made in the European. Again, because when those US markets open, often prices reverse. So they've now reversed again against the positions that we opened. And so what equity flow analysis enables us to do is to identify the maximum period of time that we will allow trades to remain open for. Now, many of those positions, of course, will close organically based on their exit during this early European session. And so this period of time where we will allow trades to remain open isn't relevant to them. But for those trades that are still open at the end of this period, we can implement a rule that now closes all of those trades, because we've got to a point where the markets are now on average going to go against the positions that we have open. I just want to make an important point here. The data that we're seeing here is relevant to the two strategies that we've been looking at, both of which are mean reversion strategies using overbought oversold conditions in the price action. For different types of strategy, so maybe trend continuation, trend following, or any other type of strategy, then the metrics that we would see in these two charts would be completely different, and they would have to be interpreted in a completely different way, and you'd end up with different sets of rules for both the time of day filtering and the equity flow analysis. And so that's why it's important not just to take what I'm saying here as being applicable to any trading strategy, because it certainly is not. This analysis has to be undertaken for a specific strategy to know how that strategy is impacted by those changes in the market throughout the trading day. So that is the theory around equity flow analysis. I'm now going to move forward in the next episode and actually undertake that analysis for the stochastic RSI strategy. I'll then implement rules based on what we find, and we'll take a look at the effect on the backtest results that we've been building up so far in the series. And then in episode 34, I'll do exactly the same for the standard RSI indicator. Before you go, would you like to find out more about how Darwinex helps thousands of traders just like you to attract investor capital? If so, either click on the Darwinex logo on the screen or find other links in the video description below. Now, until next time, trade safe.